Hello, everybody. Happy spring. Welcome to the Elevate Wealth Advisory's March webinar on investing. Today, I'm very excited to bring you one of our wealth advisors, Rob Fezekas. Rob has been with our firm here at Elevate since 2015, and he brings a wealth of knowledge to us. And although he can speak to investing and really anything about wealth advising to a very high level, today he is bringing us back to basics. What I love is if you go on our website, you can see Rob's wealth advice. And he says successful investing requires neither luck nor skill, just a good deal of patience and a little education. And today he's going to give us a little education. So I'm very excited to introduce you to Rob. Welcome, Rob.
Thank you, Betsy. Great. Welcome, everybody. Thanks for joining me today for this afternoon's webinar. Let me share my screen. I'm going to turn off my video. Okay. Great. Hopefully you can see that now.
Looks great.
So welcome to Investing 101, where we're going to go back to basics when it comes to investments. We're going to learn about sort of what investing is, how some approaches to investing, and what we've learned over the years about maybe a really good way to have a successful investment experience. There we go. So let's start with, why do people invest? Why do we invest? What is this all about? And if you answered to make money, well, that is one of the correct answers. That is definitely a reason for investing our money. We're hoping to take the money we have and make it grow and earn more money. And so that is definitely an acceptable answer. Now, if you ask a professional practitioner in finance, they may use a slightly different phrase. They might say to earn positive expected returns, but that's really the same thing. Interestingly, this is what distinguishes true investing from gambling. So gambling might be exciting, and entertaining, but the difference between a true investment and then gambling is gambling has negative expected returns, whereas true investing has positive expected returns. So we wouldn't make an investment if we didn't think ahead of time that it would earn money over time. It doesn't always work out, but at least the expectation is that the returns will be positive. Another reason why we invest our money is to preserve or protect the wealth that we already have. And this often requires some form of investment because of inflation. And we want to at least keep up with the background level of inflation to preserve in real terms the wealth that we've already accumulated. So that often requires some form of investing as well, just to preserve what we already have. And then another reason that we might invest is to shift resources that we have in the present to fund goals that are in the future. So there's a little bit of time travel when it comes to investing. When you think about moving some resources that maybe we don't need at the moment, but we are sure that we're going to need them at some point in the future. So we're going to shift those by making investments to fund those goals that may be out there many years or decades into the future. So to be clear, investing means taking risks. I think we know that investing involves risks. And one of the biggest risks is just market risk. So we know that using stocks as an example, that when we invest our money, there is a risk of loss. There's a risk that markets could go down because they go up and down. And so that is what's referred to as market risk, just the risk that the return, at least for a time, might be negative. So we know that because stocks are volatile. And this chart here shows, we'll use the S&P 500 index as an example. This is 40 years of returns from 1980 to 2020. And it shows the returns of each of those years. And what you notice is that stocks actually go down every single year. And that's important to note. And so I'm going to say it again. Stocks go down every year, even in years that end up positive at the end of the year. So the light blue bars toward the top of the screen show what the return was of the S&P 500 at the end of the year. So that's the full year return. Whereas those darker colored circles actually show where the market was at its low point during that same year. So if you look at the first year there, 1980, you see that even though 1980 turned out to be a strongly positive year, up 32%, at one point in 1980, the market was down 18%. So we see that for every single year, there certainly is a moment where the market is down. So we just need to know that that's normal and expected. Most of the drawdowns occur or are in the range of, say, 5 to 10%. It's very normal, typical. And another example, if you want to look at 2009, so here was a year toward the right side of the chart. 2009, the market was up 26% by the end of the year, but there was a time early on, probably in March of 2009, where the market was actually down 30%. So you're going to see drawdowns every year, but I think it just it helps us maintain a long-term perspective and to stay focused and invested if we just sort of expect that and understand that that's normal and that drawdowns are a feature, not a bug of markets. So we just kind of went over some the risks of one of the risks of investing, but we also need to understand that not investing means taking risks too. And that's mostly because of inflation. So we know that inflation is always kind of lurking in the background, and that slowly over time, our dollars today are not going to buy as much as they are in the future. And this chart just shows an example of the rate of inflation using a certain amount of milk and what it would cost 100 years ago in 1918 to 2018. And back in 1918, 14 cents could buy you a quart of milk, whereas 100 years later, that same 14 cents can only buy 12 tablespoons of milk. So we know that our dollars are not going to be worth as much in the future as they are today. And so by not investing, just keeping our money either in the mattress or in a bank account, we're not going to be able to keep up with inflation. And so we're going to end up worse off. And so that is a risk that not investing entails. So we want to make sure that we at least keep up with the background rate of inflation to preserve the wealth that we have. Now, fortunately, markets have rewarded long-term patient investors, especially the stock market, when it comes to keeping up with and exceeding that background rate of inflation. And so this chart shows almost 100 years of returns from 1926 through 2022. And let me start at the bottom of the chart with that light gray line. That depicts the rate of inflation. So that's the consumer price index over those 95 years. And it says $17. So what that means is that $17 in 2022 had the same purchasing power as a single dollar in 1926. And had you invested your money in short-term government treasury bills over that same time period, your $1 invested in 1926 would have grown to $22. So you would have just barely kept up with inflation. Your money be worth about the same. And government short-term bills are among the safest investments that you can make. No one's ever lost money in a government T-bill. But the low risk comes with low expected returns. If you would have invested in long-term government bonds, you'd do a little bit better. Your $1 would have become $131 over that same time period. But you can see these returns are completely dwarfed by what the stock market did over that same time frame. So $1 invested in U.S. large companies has grown to over $11,000, and a dollar invested in small U.S. companies has grown to over 28,000. So really, there's just no comparison as far as the returns of stocks versus bonds. Now, the other thing to note, though, another title for this slide could be that risk and return are related, because if you'll notice the Treasury bill line is very, very smooth, right? You don't really see any jagged ups and downs, and that's because, again, Treasury bills are a very safe investment, very low volatility. But on that stock line, you definitely see a lot of ups and downs, and that's risk, right? That's volatility. As we mentioned before, investing in the stock market definitely involves risks. Markets go up and down, and you really see that on the chart. Over the long run, they've gone up a lot, but you certainly get periods of, a year, 2 years, a few years where the markets go down, and that's just sort of the risk of investing, and again, something to just know and expect when you decide to make investments in the stock market. So that's sort of what investments are and the reason why people do invest. But so how do some people invest? And there's a lot of different ways to invest, and I'm going to go over a couple of those. A lot of people, though, do try to make investments based on predictions, and this is not just retail, individual investors. A lot of professional investors attempt to predict the future when they make their investments as well. So a lot of investing involves making a forecast of the future. Either they're going to sort of try to predict what the markets are going to do, what the economy is going to do, maybe what interest rates are going to do, or what an individual stock or company might do. And so this is not an uncommon way that a lot of people do attempt investing. Now it's difficult to predict the future. The future is unknowable, so it's not at all guaranteed that this is going to be a successful way to invest, but it is a pretty common way to invest. Some people do sort of act on their impulses and emotions. They can sort of feel like maybe the markets have done well, and that's a time to maybe add some more to the stock market when things feel good or the economy seems strong. Or after the markets come down and things don't, maybe they seem a little shaky, and we're in a bear market. It can be painful at times, and they may decide to reduce their stock exposure. Some people just have tips and hunches. Maybe they've heard something either on the news or from a neighbor about what to do. And then a lot of times people are sort of influenced by the media. If you pay a lot of attention to the financial media, they're gonna mention what's going on in the moment. It might seem dramatic, and they might be telling you what to do or what to not to do, day to day. This is likely to be sort of frustrating because you're sort of whipsawed by whatever's going on in the markets or in the news at the moment, rather than having a longer term consistent approach. So sort of this all leads to the question, what is an investment philosophy? Do you have an investment philosophy, and why is it important to have one? And so let me define what that is. An investment philosophy is simply your set of core beliefs about how markets work and about how investors should best participate in them. And there are many, many investment philosophies out there, and many of them can be successful. I'm going to talk about a couple, but probably the two things I would say are most important about investment philosophy is that, one, there should be some fundamental, rationale for why the investment philosophy makes sense and why it should work over the long run. And the other one is for an investment philosophy, it's a good idea to have one that you can stick to, even in times when it doesn't feel like it's working, because nothing works in every market, in every environment, every period. And so you've got to have an investment philosophy that you can really believe in and really stick to, even when it doesn't seem to be working in the moment. Let me talk about one very common investment philosophy. And again, this one can certainly bring success. And there are some advantages to this one. This one's referred to as either passive investing or indexing, where you're basically going to allow a commercial index provider to come up with a list of securities, and you're just going to follow that list. You're just going to buy everything that is part of that index. And I think a lot of people are familiar with this, and we can use the S&P 500 as an example. So the S&P 500 contains 500 names, just as the name would imply. And many people, if they are sort of in tune with this philosophy, they're going to buy the S&P 500 index, and they're going to own every single name that's in that index. And the names can change over time a little bit. Every year there's additions and subtractions, but it's fairly stable. And the real advantage to this philosophy is cost. It's very inexpensive to buy an S&P 500 index fund or many index funds. You can find index funds that charge much less than 0.1%, maybe even 2 or 0.03% each year. They're becoming almost free, very, very close to zero cost, and the turnover is fairly low, and so there's not a lot of trading. So it's really a perfectly legitimate strategy that a lot of people like to follow. And so this is sort of how it might look. The entire market, if we look at the US, for example, has somewhere between 3,000 and 4,000 companies that trade publicly. And the index is going to be a subset of that list, right? They're going to choose, again, and using the S&P 500 as an example, they will choose 500 out of those 3,000 or 4,000 as their index. And then they'll create a portfolio that invests in that index, and you'll own that portfolio and along with the changes that are made. And then you'll definitely get the performance of what that index does. Again, a low cost, very simple way, and a common investment philosophy. So we have learned a few things over the years about investing that might lead us to a slightly different investment approach than just pure indexing, or we might be able to enhance the indexing. It might be a better way to put it. And so I'm going to talk about a few of the things that we've learned since markets have been studied and thought about for quite a long time. And one of the very first insights that people made about markets goes back actually more than 100 years. And people refer to this as the wisdom of crowds. So, and this goes back to 1906, when a scientist, English scientist named Francis Galton, found himself at a livestock fair. And at the fair, there was a contest to guess the weight of an ox. And many people entered this contest. There were about 800 guesses. Now, Mr. Galton didn't enter the contest himself, but when the contest was over, he asked if he could get a list of all the guesses that were made. And he was provided that list, so he had a nice set of data to work with. And he took all the guesses and averaged them together and got the median. And it turns out that the median guess out of those 800 was 1,207 pounds, whereas the actual weight of the ox was 1,198. So very, very close to the actual weight of that ox. And the median guess was better than, the vast majority. Very few people got anywhere near, that close. But the median guess was extremely close, difference of only, less than 1%. And so this led to one of the first insights about the markets sort of being able to factor in a lot of information and digest that information, and how the market itself can sometimes be sort of wiser than any single individual participant in that market. So this leads to one of the first insights then, and that is to embrace market pricing when it comes to investments. There is a tremendous amount of trading that goes on every day in world equity markets. In 2022, more than $675 billion changed hands every day on average across all the world's equity markets. So that's just a tremendous amount of trading. It's going on 24/7 throughout the globe all the time. And this really shows one of the functions of markets. Of course, markets exist to bring buyers and sellers together so that they can make those trades. But another thing that markets do really, really well is they digest information, right? Everyone's opinions, thoughts, knowledge, news items, anything that's occurring very quickly, because of all this trading, because of the liquidity and the speed, this gets reflected in prices very, very quickly. And so it sort of leads one to be a little skeptical of investment philosophies that really require you to make any kind of assumption that market prices are way off or wrong, or that your guess about what a price should be is better than what the market is. It really takes quite a bit of hubris to think that you might have better information than the collective sum of all of these traders and participants in today's markets. And this is a process that's really speeding up. The information is getting filtered through to market prices extremely quickly. What's nice is you don't need to have a philosophy that rejects market pricing. There are many philosophies that embrace the pricing and still can be very successful when it comes to expected returns and having a good investment experience. So some of the other things that we've learned since that time really kind of kicked off in the 1950s, and we had to wait until the 1950s for academics in finance and economics to really begin to study markets in a scientific way, because they needed computers. There was just a tremendous amount of data, pricing data that had gone back many decades. And until the invention of computers, it would have been almost impossible to really study what makes markets move, and how to explain returns and differences in prices and the way markets work. But once computers came on the scene, they were able to really ask a lot of questions and study it in a scientific way. And we've learned a lot since that time. And what's nice is this research is all free to the public, and many of the insights that were learned we can apply to our own portfolios and our own investments. So I'm going to talk about a few of those. One of the key insights was discovering what really drives returns. And again, mostly we're going to talk about the stock market here. And we've already talked about one of the main drivers of returns. And so the academics, they like to think in terms of different factors that are risk factors, that if you have exposure to them, you can expect to be compensated for taking those risks in your portfolio. And the biggest one, like I said, we talked about before, which is the market itself, meaning that if you invest in the stock market, you can expect to earn returns that are higher than, say, short-term government bonds. And that's because investing in the stock market is riskier. And by taking on that market risk, you should be compensated with higher returns. Otherwise, people wouldn't do it. So the largest premium that you can earn is really that top one there, the market premium. So that's just the difference in returns, stocks versus bonds or stocks versus cash. And that's a big driver of returns. Historically, the stock market earns something like 6% each year over short-term treasury bills. Not every year, but that's the long run average. So that's a big premium just by investing in stocks at all. Some other ones that academic research has uncovered is company size, meaning that small companies have outperformed large companies over the long run. So there's a premium by owning some of these smaller companies that you can earn, and should be part of a diversified portfolio. Relative price is another one. Another way to define that is value versus growth. Value companies, ones that are sort of more inexpensive relative to fundamental accounting values, have done better than more expensive stocks. And then highly profitable companies have also done better. And in the fixed income space, there are a couple of factors that have been discovered that, again, you earn excess returns if you have these in your portfolio. The term premium is one. So long-term bonds generally have higher expected returns than short-term bonds. And the yields are higher because long-term bonds are riskier and are more sensitive to changes in interest rates. So normally a long-term bond will have a higher return or a higher expected return than a short-term bond. And then credit risk, investing in corporations with lower credit quality. Investors, compared to the government, you're going to expect to be compensated for taking on some extra credit risk because the likelihood that you won't get paid from a lower risk corporate bond is higher than the likelihood of being paid from or not being paid from the government. So you can earn a premium by investing in corporate bonds rather than government bonds. So how big are these premiums over time? Well, they're pretty sizable. Again, we mentioned the market premium is the largest one, but let's look at these other three. Company size in the US over the last 95, 96 years, there's been a 2% premium, small companies versus large. So again, on average, small company stocks have outperformed large. The premium for size is even larger in developed foreign markets. Small companies in foreign markets have outperformed large by about 4.5% each year on average. And it shows up with emerging markets as well, almost 3% premium. The value premium is large and positive across these three different areas of the market as well. And the profitability premium between 3 and 4%. So these are sizable excess premiums that can be earned, again, over the long run, above and beyond that market premium. Another lesson that we can take from the research into markets is it's a good idea to diversify your portfolio globally and not just concentrate in a single country. Now, the United States is the largest individual stock market in the world, and it represents about 59% of market value. So if you were to sum up the value of all the markets across the world, developed markets, emerging markets, United States, you would see that the United States is the largest one, which is not a surprise. But still, it's only 59% of the world. So that leaves 41% of world markets outside of the United States. So if you're only investing in US companies, you're missing a very significant part of potential investments that are outside of the US. And by holding a globally diversified portfolio, you're also going to have a smoother ride because other markets are not going to move up and down at the same time or in at the same level as the US. So you're going to get differences in returns. In years maybe when the US is not doing well, there'll be other markets that are going to outperform. And so in general, you should have lower volatility, lower risk, and at least the same expected return than just by sticking to the United States. So if we look at returns by country over a long period of time, so this looks back 20 years, it's interesting. A couple of things kind of pop out on this Skittles chart of country returns. And these are developed markets, so markets like Japan and the UK and Germany and France, Canada, countries like that. There's really no pattern here, no way to really predict which markets are going to underperform or outperform in any given year. And it's interesting to note that some years, if you go back to the left side of this chart, starting in 2003, for many years, the United States was actually the lowest or one of the lowest performing markets, and that most other developed markets actually outperformed the US there. 2003, 2004, 5, and 6. The US was doing all right, but other markets around the world were actually far and away higher returning in those years. And then in the more recent period, if you go look at 2018, 2019, 2020, 2021, the US has been toward the top, but it's only been the best performing market once. In 2014, the US had the highest returns of any developed market, but in every other year, there was at least one other market that did better. So what you really want is a portfolio that has all of these countries in it, and then you're going to have exposure to whatever market is doing the best that year, which again is unpredictable. It's just a random pattern here without any predictability. So it's better to have a diversified portfolio and make sure you've got exposure to all the best performing markets, whatever they may be. Another lesson is to resist chasing past performance. And this really refers to the mutual fund business, particularly actively managed mutual funds. If you look at the past 5 years of mutual fund performance and just focus on the top performers, the ones that ended up in the top quartile, or top 25% of performers, and then you follow the return of those best performing mutual funds for another 5 years, it turns out they end up looking really just like the initial group, and that only 22% of the best performers remain in that top 25%. So another way to say that is performance does not tend to persist from one period to the next, and you can't really use past performance of mutual funds to predict what their performance might be in the next period. So rather than trying to chase performance, you probably don't want to use that as your baseline for selecting funds. And there's probably better ways to choose mutual funds than just how they've done in the recent past. Another lesson, and this is one of the hardest ones, is to try not to invest with your emotions. And this one's particularly difficult because it's only natural as a human that sometimes we're going to feel better about what the markets are doing or what the economy is doing, and sometimes we're not going to feel so good about how things are going. And often, after the market's gone up or the economy feels strong or maybe the job market's doing well, that sort of feels like the time to maybe add some exposure to stocks because the markets are doing well, things are going up, and you're feeling good about it. Maybe you're starting to make some money in the market, so maybe you decide to add some more. And the opposite is true maybe after a downturn in the market. Markets have gone down. Maybe the economy looks a little shaky. Maybe it looks like we might go into a recession. Things don't feel so good at the moment. And maybe you want to back off and pull back from your stock exposure at that point because you're getting nervous. And again, these are very natural emotions that we all have. It's often not the best opportunities. Using that as our guide to make those decisions, because often, after markets have come down a lot, expected future returns are actually going up at that point. And so it can be difficult, but those are often the times actually to rebalance our portfolio, maybe actually add a little more stock exposure after they've come down in price, and you're likely to have better long-term returns if you can do that. And a study was done to see how the average stock investor did over a 20-year period compared to just the index. And it's interesting, over this period from 94 to 2013, the S&P 500 earned 9.2% annualized over that 20-year time frame, whereas the average stock investor only earned 5% over that same exact time frame. Now that's a big difference. What would explain why the average stock fund investor only earned 5% when the market was doing so much better? And the biggest reason actually goes back to that prior slide, is poor timing decisions. It's again, it's getting into the market after it's gone up a lot, and then getting out of the market after it's gone down, and having trouble getting back in after it starts to go back up again. So these things can really be detrimental to our long-term returns. And usually it's better to kind of just ride those ups and downs out and try not to trade so much based on how you're feeling at the moment. Another good lesson is we want to diversify your portfolio effectively. And really the key word there is effectively. Because if you have a portfolio, for example, that's maybe you own Netflix and Google and Apple and Amazon and Tesla and Nvidia, and that's what your portfolio is made of, well, that's probably not effective diversification because those stocks are all US large growth tech stocks. They're likely to go up and down together. They're sort of driven by the same things. And so that's probably not effective diversification. What you really want is to find some assets that are not highly correlated with each other. So you want to own different kinds of assets, different asset classes, stocks and bonds and real estate and cash. And then even within stocks, different parts of the market and different geographies, different regions, so that when some parts of your investments are not doing well, you've got other parts that are doing well, and you end up again with lower volatility and just a smoother ride and a better investment experience overall. Now, that might be a little easier said than done, but one of the most effective ways to diversify a stock portfolio is to just include some short-term, high-quality government bonds. This is a chart showing 15 years of returns from 98 to 2012. And it's interesting that when the markets were, over this time frame, when markets were not doing very well, when the stock market wasn't doing well, 5-year government treasury bonds had great returns. If you look at the left side of the chart, we'll recall the tech meltdown from 2000 to 2002. After 1999, we went into a pretty deep bear market and a recession. Markets were not doing well for those 3 years, but 5-year government bonds were doing great and had double-digit returns in 2 out of those 3 years. They were at the very top of the chart in terms of different asset classes and their performance. And so just by having some 5-year government bonds in your portfolio, that would have really helped in those 3 years when stocks were not doing so well. The next 3-4 year period, stocks actually started to come back and had very strong positive returns. And there you see 5-year government bonds are at the bottom of the list. So they're still positive, but stocks are doing a lot better and bonds were just doing all right, kind of low single-digit returns. But again, diversifying your overall portfolio. And then if you look at 2008, which was not a great year for stocks as we were entering the global financial crisis. Stocks were down 40 or 50% at one point in 2008. But 5-year government bonds were up 13%. So that would have been great to have some of that in your portfolio during that year. And then 2009, again, the exact opposite. Stocks came roaring back, had a great year. And then 5-year government bonds had a slight negative return. So they've been a very effective diversifier. Now, nothing works, as I mentioned before, in every single period. And 2022 was actually an example where this strategy would not have worked. So nothing's perfect all the time. In 2022, with the large rise in interest rates, we had negative performance in stocks and bonds. But more often than not, bonds have been quite a good diversifier to a stock portfolio. Another thing that we'd like to do is try to ignore the headlines, the financial media, and invest for the long term. If you pay a lot of attention to the media and the headlines, it can feel like we just kind of move from one crisis to the next, and this is what they're going to focus on, and because it's going to get a lot of attention. And it can feel at times that there's always a reason to sell. There's always some bad news going on somewhere. And it's not that markets don't react to that news. Sometimes they do. We certainly got a downturn after 9/11. We got a little downturn after Brexit in 2016. Obviously, the COVID pandemic caused a short-term but very deep correction in the market. So markets will react, but if you look over the long run, you see that they generally come back, sooner or later. And it's probably a better idea to try to tune a lot of this out, and because it's likely to be just kind of an exercise in frustration to try to time the market and trade based on the headlines rather than just kind of stick through thick and thin and let the markets work for you over the long run, because again, they have rewarded that patience if you can just kind of have a long-term approach and stay in for several years. And finally, we do want to focus on the things that we can control. Unfortunately, we can't control what the markets are going to do as much as we'd like to. That's out of our control. But there's a lot of things that are under our control. So these are probably the things that make more sense to focus on. It's always a good idea to have an investment plan, one that fits your risk tolerance and something that you can stick to through thick and thin in the long run. And you can structure a portfolio along those factors of expected returns that I talked about earlier that have been uncovered by research into how markets work. You can diversify your portfolio globally. You can try to minimize your expenses, your taxes, and your turnover in the portfolio, and then stay disciplined through market swings. These are the things that are under our control and are very likely to give us a better investment experience over the long run. So with that, I will end the presentation and stop my share and be happy to take any questions.
Thank you so much, Rob. That was fantastic as always. If anyone has questions, there is a chat box as well as a Q&A box, or you can raise your hand with that little hand icon. We do have a couple questions. One is, I'm 10 years away from retirement, and while I have a 401k through work, I regret I haven't started investing. Is it too late to start?
It's probably never too late to start, but being closer to retirement, you're going to want to be cautious about the risks that you take. It sort of makes sense to have a more conservative approach as you get closer and closer to retirement. So when you're young and you're just starting out, often you can take more risk in your portfolio. But even 10 years before retirement, you still got a really long time frame ahead of you, because you're also funding your entire retirement period, which can be 20 or 30 years. People are living a long time. So with that, even though you may only be 10 years from retirement, you do have to think even beyond that. And again, to keep up with inflation, you're going to want to have some kind of investment plan that can at least preserve the wealth that you've accumulated in your 401k.
Very good. Thank you. I see a lot in the news about investing with AI. How hard is it to do this myself?
Oh, I don't have a lot to say about that. Investing with AI or sort of using that theme in your investments.
Yeah, a lot of news.
Yeah,
Invest.
there is. I guess it's not something that we've incorporated here. So I guess I don't have a lot to say about how you would use AI to invest. Um, I will say that it's probably just another tool that makes the markets even more efficient and allows information to spread more quickly. And I'm not sure that there's a huge advantage as far as the outperformance using AI, because it's still not going to be able to predict the future or really not know something that's already incorporated in the market. But it might just be a more efficient way to access investments.
Got it. The other part of that question, how hard is it to do this myself? When you talked at the end about a better investment experience working with an advisor, can you talk a little bit more about that?
Sure. I mean, a lot of people do this on their own, and a lot of people use advisors, and it's sort of up to the individual if they have an interest in learning about investing or following their investments. A lot of people do this on their own, and they have great success. Then there are other people that really it's either something they're not interested in, or maybe they're just very busy, and they would like to kind of outsource this to a professional who can pay attention to their portfolio. Both approaches can work, and it's really sort of up to you, sort of what sort of time commitment you can make. But really, anybody can learn this and use this in their own portfolios if they have that desire.
Very good. Well, thank you so much, Rob. And for everybody watching, Rob handles most of our investing at Elevate Wealth Advisory. He's also well versed in many different parts of wealth management. At Elevate, investing is just one piece of the overall puzzle. We really like to get to know our clients, try to understand what your future goals are, and help you create an overall wealth plan so that you can meet those goals now and in the future. So if you'd like more information, you can email info@elevate-wealth.com. You can also just visit our website at elevate-wealth.com. And at the bottom, you'll see links to our YouTube channel where this will appear later today, but then also all of our past webinars and our weekly YouTube video series. Thank you so much today, Rob. I appreciate all that you always do, and I'd love to have you on.
Great. Thanks very much.